The main thing I want to go through today is, and then what we'll cover is the fact that time reduces your volatility. Diversification leads to a more stable and robust portfolio, making sure that we're avoiding any emotional decisions through this volatile time. Make sure that we have our portfolio managers doing their job from a very educational standpoint. They're the ones that are doing all the research on that daily basis. We've got a lot of trust in them, making sure that we're focused and disciplined and staying within the plan on the long term here. Most of the planning that we do at IG is long term, and making sure the goal here is to stay invested. We'll go through the fact that staying invested is your best bet here. So as you can see, 2020 has been far from normal. It's been, as the headline says there, pure madness. So we can see here, if you look at this graph, you can see here the Toronto Stock Exchange or the S&P 500. So these are the two colors here. They are the bottom performers. At one point, they were down as low as about 35% off from where they were starting the year. So that's not good. And what we can see is now some of our more popular portfolios here are listed as well. Still down, but not nearly as much. So we can see there, what that tells us is our portfolio managers have been doing their job. So we know that, and we know that the portfolio managers are doing a good job to say, hey, let's mitigate our losses and make sure that we're not going down as far as what the stock market is. So definitely a good thing to see that, and to see that especially some of our more popular funds are not seeing the losses that the stock markets are right now. Now, when we talk about the news loves their headlines. March 9th, 2009, we saw the death of capitalism, and what that never really happened. 2008 was a bad year, absolutely, but never really happened as far as that's going. And you can see some of these other headlines here as well. Anyone remember the fiscal cliff? So we didn't really have that. It didn't really happen. What about Brexit? Well, it didn't really change the world at all. We talk about, Greece, all this stuff. It's just to get headlines. These guys are in the business of selling news, and they do a great job of it. But that's not really what's going on behind the scenes. And all while this was happening, the markets are still climbing. So now, if you look at the Toronto Stock Exchange, generally trending upwards, but we do have little blips here and there. It's not completely up. It's not a straight line. It never will be. There's always that short-term noise. So we look at that and we say, hey, generally speaking, year over year, the average annualized return is 8.93%. But we always have these market declines, and you can see here double-digit declines on all of these years for a little bit of a duration here. And they never last that long, aside from a few here. They're a little bit longer, but and you can see here 2000 was a longer one, but it always comes back. And overall, it's been 8.93%. So pretty good as far as where the investments are going, but we do, of course, have that short-term volatility as well. Now, it is darkest before the dawn, so if we look at this and we say, hey, let's take that negative rate of return that we have on some of these years, some of these pretty serious, pretty major corrections, and let's look at what the markets do after the correction is done. And we look at that and we say the 12 months following the correction, with the exception of one time here in 2001, it's always been positive, and it's been positive higher than the negative here. Not only that, but if we extend it out past that another 5 years, so 5 years past that, these are some pretty big positive returns. Even if it's annualized, you can see, hey, we are more than back after 5 years of the negative return there. So you look at some of these, like 74 here, down minus 31%. And in the next 5 years, we got back 168%. So it's always short term if we're looking at this. So now we look at the 5 principles of your living plan. So we have a living plan in place for each client here, which means let's use time to our advantage. On the next slide, we'll show that time really does work in our favor as long as we stay invested. Now, we talk about diversifying our portfolio as well and saying we're not looking at a specific type of funds, but we should have a broad range of different funds because it's impossible to know what type of fund is going to perform the best. Let's make sure we take the emotion out of it and we have to stick to the plan. That's the main thing there. Maintain that long-term focus and make sure that we are focused on the long term. Now, a lot of people will look at this and say, well, Darcy, that's great, but I'm retiring in a couple of years. How can I have a long-term focus? What I always mention to people is even if you are retiring in a few years, ideally we want to stay retired for a long time. So we might have 2 years from now or 1 year or whenever the retirement starts where we need some conservative investments for what we need to take, but you're not going to take all of your retirement funds right away. Ideally, we're retired for a nice long time, which means we still, even going into retirement, have that long-term focus. We'll talk a little bit about what it means to stay invested. It is notoriously difficult, and I would even say impossible, to time the markets, and we'll show you some statistics that prove that. Let's jump to the next slide here and show time is your advantage. So if you were to take all of your money and put it into the Toronto Stock Exchange, just buy a little bit of everything, and we left it there for exactly 1 month. Doesn't matter what month that is between 1947 and 2020, that 1 month, there is a 61% chance you would have gained money. But that means there's a 39% chance you would have lost money. Now, better than 50-50, but I don't really like those odds. But if we change it now from 1 month to 1 year, that 61 increases to 73%. Better odds, but still not great. If we do 3 years, it's 90. 5 years, almost guaranteed. And in that 10 years, there has never been a 10-year period between 1947 and 2020 where the market has lost money. So if we're invested for the long term, we know that that's going to work for our advantage. If we're invested for the short term, we really are taking our chances there. So keep that in mind as well. Now this next slide here, we call this the jelly bean chart. So if we look at 2010, for example, and we say what type of funds performed the best, and we look at this right here at the top, Canadian small cap. And if in 2010 you said, hey, I want the best, I only want the best, I don't want everything, I just want the best, we could invest in Canadian small cap. That's great. But in 2011, where's Canadian small cap? Well, it's right down here. It is the second worst performing type of investment. And you think, well, that's not great. Maybe I'll invest in Canadian bonds. If you invested in Canadian bonds, that type of investment in 2011 is the best performing. But then in 2012, it's third worst. So what we want to do is rather than pick one or just a few of these types of investments, we really want to select all of them. And all of your portfolios will have a small portion of each of these, some more than others, depending on your risk and depending on your timeline. But that way, it doesn't really matter which one performs best, which one performs worst. We're going to be okay over the long run. Now, we talk about the emotion. It really is like a roller coaster ride as far as investing is concerned. But really, we want to look at that long term here. So we know when the markets go up, hey, everyone's happy. Everyone loves to talk to me when the markets are up. But when the markets are down, we're feeling a little bit dejected. Maybe we're feeling nauseous, that sort of thing. But if we can take the emotion out, and it's definitely tougher than it sounds, then we will be better off, and we can actually take out those emotions and let our portfolio managers do their job rather than us worrying about are we in, are we out, that sort of thing. So now this here looks at our returns, whether they're positive, negative, what sort of range they're in from every year from 1948 to 2019. So we have 72 years in there. And you can see 22 of those 72 years have been negative, and 50 of them have been positive. So roughly 70-30. I call this the 70-30 rule, which means year over year, 70% of the time, you're going to get a positive return, but 30% you're going to get a negative. But then you look at the ranges and you say, okay, in 2009, 1983, 1979, 1961, and 1950, all of those years returned a positive return in the range of 30 to 40%. But then we go to the other side and say negative 30 to 40. Well, there was only 1 year in that period, 2008. So 5 versus 1. Then you look at the 20 to 30. We've got 5, that's 6, 7, 8, 9, 10, 11, 12, 13 versus 2. So I don't like those odds over the long run. If we were just to pick a year at random, it could vary. There's a 30% chance now that it could land on the negative side. Now this one here is interesting because really hits home the fact that we need to stay invested for the full year, and to say I want to pull out and then put back in and then wait till it goes up and try and get the best trading days. It's very unpredictable. So if you have a return or if you stay in the market the whole year, that's 365 days of that year, then you're going to get a return of 7.7% on the TSX. This is going back to 1990 here. If you pull out and you miss out on the top 10 trading days of the year, that's it, just the top 10, your 7.7 is going to decrease to 5.3. If we miss the top 20, it goes to 3.5. And look at this. If you miss out on the top 50 trading days of the year, doesn't matter what year, any year between 1990 and 2019 there, your return actually goes negative. So we need to be invested because we never know. And it's notoriously difficult, and I would say impossible, to know whether the returns are actually going to be positive or negative. So, or on a given day anyways. So now we have your living plan here. The idea is to make this as robust as possible. Make sure that we're not just talking investors or investments. Now we changed our name recently from Investors Group to IG Wealth Management. That's because, hey, guess what? We don't just do investments. We do all of this stuff here. So let's make sure that we talk about all of this and make sure that we are taking care of all of this, and make sure that we are tax efficient, make sure that we have enough cash flow. That can be a concern for some people now. If there's no income coming in, we have to worry about that. We have to worry about preparing for the unexpected. Nobody really saw this coming, at least not for that long anyways. So do we have an emergency fund? Major expenses coming up, have we planned out for them? So we can talk about all these things and know that it's not just about the numbers, even though that's the majority of what we talked about so far this today. It's not just about the numbers. It's about having that full-on robust plan that's going to address everything. So now, obviously, as your consultant here at IG, we talk directly to you. We do have our in-house specialists, whether that's to do with taxes, securities, insurance, mortgages as well. And then you're going to have your specialists as well, any lawyers, accountants, that sort of thing. So make sure that we're talking with everyone. Make sure that we are involved with everything, and we can certainly help you out. And we can talk directly, and I do this with some clients as we talk directly to their accountants on their behalf, sort of thing. So we can share information that way with your permission, of course. So big part of the IG living plan is figuring out your retirement paycheck. How much do you need per month to survive through retirement, and how much will you get? And we can do some projections and figure that out, what this number will be, your retirement paycheck, and is it enough to continue living the life that you want to live. Now we also talk about here, I call this, or it's called Monte Carlo analysis. And what this is we can make a great plan for you, but then we want to stress test that plan. And that's what Monte Carlo analysis will do, and say, hey, you know what? We make a great plan, but what if this happens, or what if that happens? And we can run all these trial simulations to determine, is our plan actually going to work? Are we going to be okay? So we can make sure that not only is this a good plan, but is it a robust plan as it is, and is it actually going to work for you? So that kind of sums up that what we've talked about here. So do you have a robust living plan? Well, if not, let's talk and let's make sure that we have that in place. Make sure that we're diversified. We're not just in one specific type of funds, but we're properly invested throughout different types of investments there. Let's make sure that we are invested for the long term, we stay invested, and we reduce our volatility by doing so. Make sure that we're disciplined and we've got a focus on the long term. That's the way you're going to win in the long term here. One thing I want to suggest as well is if you are doing okay from a cash flow standpoint, we still have income, maybe we have a little bit extra cash sitting around in a savings account, that sort of thing. This is an opportunity to invest. We always say buy low, sell high. We are low, so this is the buy low right now. Now, that being said, we want to make sure that we're okay in case the employment dries up, that sort of thing. But if this is an issue for you, or if you wanted to discuss this, let's talk about it further, because let's face it, everything's on sale right now. So that being said, that's about sums up everything I had. So a little cartoon for you there. Happy Easter to everyone. Don't do what the Easter Bunny says. Do not put all your eggs in one basket. We need to diversify through different types of funds as well. So that being said, let's jump in and see if we have questions here. I'm going to go through and just take a look. It says, are you up and running? Sorry about that. I was a little bit delayed there. So great question here. And this reads, are we able to move invested money around in order to take advantage of some of the down markets? The answer is yes, absolutely. Nothing that we have invested is locked in. So we can move it around. We can maybe move, in this case, from something that's more conservative to something that is maybe a little bit more aggressive. Now, keep in mind as well, this is at our level here. We have these moves going on a regular basis at the portfolio manager level. So for each of the portfolios that you have, a lot of you will have, maybe a dozen of them, maybe just a few, but at that point, they are going to be doing these moves on your behalf. So these portfolio managers on a daily basis are going out there and they're looking for deals. They're looking for, what do we need to buy? What do we need to sell at this point? So that's a great question. And there's two ways that we can do it. The one is at our level here and say, hey, do we want to be in Canada? Should we be in the US? Should we be in Europe, Asia, that sort of thing? Now, keep in mind as well, as we recover from this, different countries are going to recover differently. So if we look at China right now, they're out of their lockdown. They're back to work. They are a few months ahead of us. Now, we don't know if that's going to last or if that's going to be permanent, but right now, their recovery has pretty much completed. Then you look at Italy, not a chance, not yet anyways, but you would argue that maybe they are a little bit ahead of us. So do we want to invest in Europe now, knowing that they're closer to recovery than we might be, kind of thing? So that's decisions that a lot of our portfolio managers are making on that sort of macro level. We can do it at our level as well. So let's see what else we have. A lot of people asking, hey, are you up and running? We are now, so looks like everything's good here. So another question here, is it a good time for me to add to my RSP? I would say it's a good time to add, and that's a question there that's specific to your situation, whether it's RSP. Essentially, we break it down. We have three, it sort of oversimplifies things, but we have basically three options here. You have your RSP, you have your TFSA, and then you have, call it everything else, you're non-registered. So would you add to the RSP? Well, let's talk about your specific situation and say, hey, if you have extra money, and you're not worried about cash flow coming in, or maybe you've got some of the benefits that Government of Canada has rolled out now. As long as you're comfortable, don't go all in, but yeah, absolutely put a few dollars in. Now is a great time. Everything's on sale. Now, one of the good analogies I like to bring up here is the price of gas. So if anyone's gone out and filled up with gas right now, well, it's pretty cheap. So we know that gas is going to be fairly inexpensive right now. If you want to buy gas now, you want to fill your tank, great. Are you going to be upset if the price of gas drops even more? Well, not really if we're looking long term, because we know that at some point the price of gas is going to go way up back to where it was and beyond. And it won't be long before we're spending $1.30 or $1.50 per liter, as opposed to, I looked at the gas station outside my house here in Calgary and it was 59 cents to fill up per liter. That's the lowest I've seen in quite a while. So think of that. And yeah, we are buying on sale, but if we do that and we're putting money in, make sure it's for the long term. We don't really want to put money in and decide, it's come up, now we take it out a month later. Really, this is a long-term play, and it should be, we're talking probably 5+ years here. So now, that being said, okay, so one more question here, and then I do have to run. I have another 11 o'clock appointment here. So last question here is it a good time to maximize my TFSA now? I would say, again, similar to the RSP question from before, absolutely, it is a good time to put money in, as long as you're not right at the limit and you don't have any money. Now, there is a strategy as well where you can, believe it or not, borrow to invest. It's called leveraging. If you want to leverage, this is a fairly high risk maneuver. What this will end up doing is it will magnify your gains, but it could also potentially magnify your losses. So if you're doing a leverage strategy, make sure that you consider yourself an aggressive investor. Otherwise, you don't have to borrow. You can, if you've got extra money, put it in. What you could do as well is, a lot of you are set up with pre-authorized contributions. That basically means, hey, every 2 weeks you take a set amount from me, or every month take a set amount from me. If you can handle it, now is a good time to increase that just a little bit, and know that, hey, if we're at $500 a month, maybe now we're at $700, just for a few months. As long as we can handle it, then we can bring it back down. So the idea there is, when things are on sale, we buy more units of it and it's worth more. So that being said, that kind of wraps up what I've got here. So actually, one more question, guys. I think this is a great one to address here. I want to make sure that we do address this. Of course, everyone knows that we do insurance as well as investments. So the question reads, can I buy life insurance and be covered for COVID-19? So life insurance will cover, it's pretty binary. You're either alive or you're dead. Life insurance will pay out 100% for COVID-19, for any condition, as long as you're approved. So yeah, absolutely. Life insurance will cover COVID-19. Now, what it will not cover, or what will not cover COVID-19, is if you've ever considered, or if you have critical illness insurance. COVID-19 is basically the flu. It's a type of sort of influenza. Obviously, it's not just influenza. It's a little bit more serious than that. And your critical illness insurance will not cover these types of diseases. So unless it is specifically listed on there, which it won't be, it's too new, it will not be covered by critical illness insurance. But yes, absolutely, life insurance will cover it. Disability insurance will cover it as well if you are off work due to COVID-19. But know that a lot of disability insurance policies will have a waiting period. So you would have to be off work because of this disease, because you cannot work through disability or illness, for usually a period of at least 30 days. So that's going to be listed in your specific policy. So we'll have to leave it there for now, but please let me know. Feel free to reach out. We are still responding to emails, phone calls, that sort of thing. We're just not doing it within the office. We're happy to help. Thank you again for joining me, and sorry for the late start there, but everything should be good. Thanks again, and happy Easter to everyone. Bye.